Thank you, Mark. Well, yeah, so much to look out for today on the show. First off, let's get to the top stories that set to agenda. It's the midweek trading session. That's starting right now, but let's get a check on what's playing out in the FX market. What played out in the FX market, that was yesterday. We see the Naira experience a slight depreciation, trading within a range of about 1,540 Naira to 1,552 Naira. To the dollar, closed at 1,552, reflecting a 0.18% decline. Additionally, we see Nigeria's gross external reserves. That saw a minor decrease of about 0.14%, standing at $40.30 billion as of January 15, 2025. Let's get a check on the oil market now. See oil prices slid today, extending the losses as the markets, digesting President Donald Trump's bold policies on his day one in office, with most of those declarations. And we see Brent crude, that's down about 36 cents, trading 0.49% down, $78.91 a barrel for that's Brent. WTI crude, that's trading at $75.36 a barrel, 0.61%. So we're seeing oil starting off quite weak there in the market. Let's get a check on other stories now. The Nigerian midstream and downstream Petroleum Regulatory Authority says it has given a license approval for the construction of a new refinery in Delta State. In a post on its official X handle, the NNDPRA's chief executive, Mr. Farouk Ahmed, said he presented a license to establish a 10,000 barrels per day refinery at Imoda-Igeli, Delta State, to MRO Energy Limited. This development comes 2 months after the regulator granted a license to Process Design and Development Limited to establish and construct a new 27,000 barrels per day refinery located at Dolowore area of Gombe State. The latest approval also signifies that Nigeria now officially has about 11 modular and regular refineries, adding to the nation's refining capacity. And 12 matters now. See, Portugal is set to boost its imports of liquefied natural gas from Nigeria and the United States as part of efforts to reduce reliance on diminishing Russian gas supplies. In a statement at the World Economic Forum in Davos, Portuguese Environment Minister highlighted the move following sanctions on Russian oil and gas imports. That's through the pipelines. According to the data from grid operator REN, in 2024, Portugal imported 49.141 gigawatt hours of natural gas, with Nigeria supplying 51% of liquefied natural gas. The US, that contributed about 40%, and Russia accounting for just 4.4%. So we see other countries there taking advantage of that gap there. And now to the telecoms industry. The National Association of Telecoms Subscribers, that's NATCOMS, they're rejecting the 50% increase in telecoms tariff, which was announced by the National Communications Commission. That was on Monday. I guess that's expected. Customers would obviously reject a price hike. The president of NATCOMS, Deolu Ogunbajo, he made this known, says the association kicks against the 50% hike, citing that a 5% to 10% marginal increase was a better option, according to him. He also mentioned that NATCOMS has decided to take decisive action to stop the NCC from implementing the tariff increase, as the telecoms regulator did not consult subscribers on the matter, because at the end of the day, I guess the subscribers are the ones that are going to pay. So there's still a lot to look out for there when it comes to the tariff increase there for telecom operators. All right, now to some market news. We see Stanbic IBTC Holdings has unveiled the facts behind its 148 billion naira rights issue in Lagos yesterday. The holding company says the event underscores its commitment to maintaining transparency with investors while bolstering stakeholder confidence as it solidifies its position in the capital market. The rights issue opened on January 15 and closes on February 21st, 2025. Take a listen.
Stanbic IBTC Holdings PLC is in the spotlight as it hosts its much anticipated Facts Behind the Rights issue presentation at the Nigerian Exchange Group House in Lagos. The session provides stakeholders and investors with insights into the holding company recently announced 148 billion naira rights issue, offering over 2.9 billion ordinary shares of 50 kobo each at a discount rate of 50 naira 50 kobo per share below the current market price. Stanbic IBTC Holdings PLC is offering this to existing shareholders on the basis of 5 new ordinary shares for every 22 ordinary shares. The executive management of the company speaks of the group's track record.
Following the CPI capitalization policy in 2005, IBTC merged with Chartered Bank and Reject Bank, changing its name to IBTC Chartered Bank. In 2007, IBTC merged with Stanbic Bank Nigeria and Standard Bank gained control of the combined entity in a $1 billion transaction to form Stanbic IBTC. In 2012, following the cancellation of the universal banking license regime by the central bank, the holding company construct was adopted. We started with 8 subsidiaries, and we have seen grown to 11 subsidiaries, adding insurance brokerage, life insurance, and lately payment services.
The chief executive of Stanbic IBTC Bank, Mr. Wole Adeniyi, outlines how the proceeds of the capital raise will be allocated.
42% of this proceeds will go into the corporate and investment banking part of our business. 27% will go into our business and commercial banking. The large enterprises, the agri opportunities, the small and medium scale opportunities, this is where you are going to see those funds being utilized. And then from the personal and private banking business, we are going to use 11% of these proceeds. One area that we're good at is digital lending, and we're extending that capability.
With this rights issue, Stanbic IBTC Holdings hopes to join the League of Banks in the country, raising the capital base in line with the new minimum capital requirements set by the Central Bank of Nigeria. The CEO of the Nigerian Exchange Limited speaks about the financial sector's impact to the market.
Between 2019 and 2024, the value of shares that are traded in our market is about 8 trillion naira. 51% of that, which is about 4.2 trillion, was traded by the financial services sector. So they really play a critical role in our market. And to the investors, within that period, they have also distributed 12.4 billion naira as dividend to all the investors.
Stanbic IBTC Holdings PLC promises shareholders a rewarding journey as they exercise their rights. Will Ibong, Channels Television News.
All right, so we'll see the National Bureau of Statistics has rebased the country's GDP and consumer price index. So definitely the numbers we're going to be seeing going forward would be from the rebased data there, and it's supposed to reflect the current economic reality. So joining us to unpack what to expect, for these numbers, we have Basil Abia as a co-founder of Veriv Africa. That's Basil Abia joining us from our Abuja studio. Basil, great to have you. Basil, let's look at what we're seeing here with the GDP rebasing. That's if we can go to our Abuja studio now. Yes, if we go to Abuja studio, we're talking to Basil Abia. Hello, Basil.
Hi, Ladi.
Fantastic. Great to have you. Great to have you, Basil. So first of all, I'd like to get your reactions now. So definitely, it's official. The data is rebased. I'm talking about CPI and GDP. What are you expecting? Because for January, that's come 31st, we see the Nigerians, the MBS there said that the data is going to be rebased. What are you seeing coming?
Yeah, I don't see much changing with GDP expectations for 2025. I mean, we've had corroborations from both IMF and that of the World Bank. They just recently released their outlook for the world and for respective countries. In Nigeria, unfortunately, Nigeria is still within the 3% range, just like the Verif Africa macroeconomic outlook, GDP outlook base case scenario for Nigeria would be 3.1%, without a doubt, and then best case scenario would be 3.64%, and then of course worst case scenario would be 2.53%. So those are the three scenario-based forecasts for GDP, and it's not changing. It's not changing because, again, the methodology behind rebasing is distinctively different from that of the CPI. Now, with the CPI rebasing, they are changing both the weight reference period as well as the price reference period. The weight reference period will be 2023, and then the price reference period will be from 2024. So those are the base years with which they're using to analyze and calculate change in prices, aggregate change in prices regarding or with the context of the base year as the fulcrum. Now, with this base year that has now been changed to the peak period of 2024, you can expect significant changes because unlike the GDP where you're not expecting a lot of changes, with CPI rebasing, when you're increasing your price items from over 740 items calculated to over 960 items, and then you're recalibrating the weighting. So the food weighting, for instance, technically used to be 51% based on the 2009 price reference period. That was the weighting that they were using. Now they've changed the weighting based off of the survey that they just carried out. I'd forgotten the term, but the survey was carried out in 2023 and results were out in 2024 by the Living Standards Survey, by the National Bureau of Statistics, and based off of that, expenditure weighting for food has now reduced. So weighting will now be 40%. So when you're reducing the weighting and you're increasing the amount of items that you're calculating for price aggregate changes, definitely you should see a significant CPI reduction. So our projection for worst case scenario for aggregate inflation rate for 2025 definitely is changing. We started off, again, like I mentioned earlier, this year and then late last year as well when we were on Business Morning, we started off with the projection that at base case scenario will be at 31% headline inflation, and then at worst case scenario will be at 37%. Fortunately, we have that reduction to at least the 20 percentile range rather than the 30 percentile range. So what do I mean by that? It means that because of the context of the CPI rebasing and the methodology that I just explained, the calculations now reduce to around the 20% range. So for best case scenario, we're expecting headline inflation to be aggregate of 24%. And then for base case scenario, we're expecting it to be at 27.01%. And then for worst case scenario, it will just very close to 30%, will be at 29.08%. Those are the calculations and the assumptions behind our projections for CPI and GDP for 2025 based off of the new rebasing that MBS is carrying out.
Right. So, definitely there are changes there. We know the central bank and the MPC, they've been moving to, tackle inflation, most of 2024. It's a new year, 2025, and I guess the battle against inflation continues. But do you think the rebasing, does it help the CBN MPC with the decision, or does it make it a little more sketchy for them?
It makes it more sketchy. Definitely does that, because what you're seeing, again, because the peak period for the price reference is in 2024, the base year is 2024, and there's distinctive context to read in there. The context is that most of the price shocks happened in 2024. Yes, a lot of the shock therapy carried out by CBN and the Bola Tinubu presidency was carried out in 2023. You had the devaluation of the naira. You had the cross-reflective tariffs in electricity. You also had the subsidy removal and just adjustments of price from 198 naira per liter to over 600 naira per liter. And then again in October 2024, there was another adjustment to over 1,000 naira per liter. It's hovering between 1,100 to 900 naira per liter. So all of these adjustments saw most of the price shocks happen in 2024. And when you use that you also have to put the context what the month-on-month inflation rate is. Aggregate month-on-month inflation was about 2.15%. So if you put all of this into context, of course, you're going to have inflation rate that is not really reflecting the aggregate adjustment of prices on a monthly basis, and that gives it a much tougher job for the Monetary Policy Committee. But again, like I said, due to our projections not being significantly different from what we had already said 2025 was going to give us last year, this year using the CPI rebasing, because the base year is still the base case scenario is still hovering around 25%, 26%, and 27%. That adjustment, while sketchy, it still be something that the MPC could look to ensure that MPR is still steady. There are no cuts to the MPR hikes, especially if you're reading most of the outlooks for interest rate hikes in the US or in the UK.
All right,
Basil, again, and of course, the Feds are all going to cut their hikes at least twice next year, according to projections.
You've already led me to my next question at this point. It's all about hikes. Investors also want to know forward guidance on what's going to happen, when it comes to hikes. We already know what's coming for the US, but looking at Nigeria and the MPC now, let's just fast forward. We see for January 31st, we get the CPI data for January, and it shows maybe sub 30%. What should be the next move by the MPC? Do you think they should hike or just hold to watch things?
MPC should hold. That's just the truth, There are a lot of exogenous shocks that we should expect in 2025. First, the Trump presidency. They are already touting this drill, baby drill mantra, basically saying that they're going to drill more oil. They have unfrozen all of the freezes that Joe Biden did with regards LNG gas exports. And then, of course, further explorations. As we do know, of course, explorations do not account to production. It takes a while. There's a time lag in that regard. But with the current context of production in the US, definitely production would hike. Aside that, let's not also look at oil. We have to also look at the tariff wars that President Trump is also touting, and he's announcing 25% tariffs on Canada next week, as I speak, according to pronouncements made by him yesterday. So these exogenous shocks expected. We know that with tariffs, there is increase in aggregate inflation in the domestic economy of the US, and when there's an increase in aggregate inflation, there's that tendency for US yields to be higher, and FPI inflows definitely reduce when it comes to emerging market bonds. And so because the US yields are higher, emerging market bonds are riskier. There's that safety flight capital thinking from foreign portfolio investors, so they move most of their monies back again to the domestic equities market in the US. And so we're going to see FPI inflows recede significantly this year based off of this assumption of exogenous shocks. And with that, we're going to obviously see risks to our currency strength. And with risk to our currency strength, like we all know, the inflation pass-through from exchange rate will be very high. So inflation definitely is going to be significant again, not as heavy with the price shocks of last year, but definitely those price shocks from the exogenous shocks will be there. And I think that the MPC folks would want to hold. My advice is that they should hold.
All right, definitely. I'm sure some were hoping would all leave inflation behind in 2024, but that's not looking like the case. Well, thank you so much, Basil Abi, as a co-founder of Africa. Always great to have your perspective. Thank you so much.
Thank you, Ladi. Always a pleasure.
All right, take a break now. When we come back, we're going to head straight to the fixed income market and get a sense of what to expect for the Naira. That's in a moment. Just stay with us. Welcome back. Let's get a check on the fixed income market. And to help us unpack this, we have joining us Oladipo Ajayi, is the head FX and fixed income at Chapel Hill Denham. Great to have you on the show. Happy New Year. Good morning.
Good morning, Ladi. Happy New Year. Nice being on your show this morning.
Yeah, always great to have you. But we know the action now. The markets have started, action already, and the fixed income market not left out. We're seeing some contraction there with average benchmark yields for the OMO and NTB bonds. While in the secondary bond market, we saw some expansion of yields there. Help us understand what's playing out in the market.
Okay, what happened is that at the beginning of the year, the DMO actually released the calendar for the treasury bills issuance for Q1. And what we noticed was that the total maturity that we are expecting in Q1 is about 5.2 trillion. And the total issuance for Q1 is about 4.3 trillion. So what that means is that there will be net inflow of about 900 billion hitting the market in Q1. So the signal that this sent to the market is the fact that market is expected to be a bit aggressive in that direction, and that's one of the reasons why you are seeing that from the last NTB auction where the rate closed around 22.66 levels. Now the same instrument is trading around 21.5% in the market. That's about 110 basis points from where it was actually issued a fortnight ago. And exactly the opposite is what's happening in the bond market, because when the calendar was released, we noticed that the DMO is ready to issue about 1.8 trillion in Q1. So that's like an average of about 600 billion on every month in Q1. And so the signal that they sent to the market is more like that simply means that the government will continue to crowd out the bond market, and that led to a lot of people trying to actually sell their existing position in anticipation of the new incoming bond. And one thing also that we noticed is that the new calendar shows a new 10-year bond. Although the DMO is currently reopening the 2029 and also the 2031, but there's a fresh 10-year bond. Now, one thing you all know across the world is that 10 years is more like a benchmark bond. So anyone that's actually investing in the market will want to hold a 10-year bond because it's more like a metric to calculate a lot of investment return. And I guess that's one of the reasons why we are seeing a sell-off in the bond space, and we are seeing a lot of interest in the treasury bill space.
Right. And what are the potential implications of these yield movements, for the Nigerian economy, including, government borrowing? We got that data earlier today, total debt stock hitting 142 trillion. So, definitely we're seeing debt still ballooning at this time. Talk to me about how this impacts the Nigerian economy, because we're trying to get somewhere, in 2025.
Well, the sense that the market is having from the budget for 2025 is that the government is still a bit bullish in their borrowing structure. And one thing is that, when you are bullish to borrow, it means that you borrow at elevated rate. I think the only solace for the government is the fact that we may see a less aggressive monetary policy guide for the year 2025, considering the CPI rebasing, and coupled with the fact that we'll likely enjoy a bit of high base year effect, which will actually necessitate the monetary policy guide to actually hold for a major part of the year, and maybe later part in the year start looking at actually cutting rate. And I think the global economy is also one way or there could be more like a solace as well, because we're seeing global inflation actually retracing, and what that simply also means is that we could start seeing a bit of more inflows to our markets. So for me, I think that we are still very much aggressive when you look at it all in all. And it also simply means that this year, 2025, may not be greatly different from what we saw in 2024, where the corporates have found it very difficult to actually access the capital market to raise bonds. Imagine last year where the government is borrowing at 22%. Of course, an average corporate that wants to come to the market to actually raise a 7 to 10 year bond will actually pay close to about 28 to 30% to actually raise funds in the market. So it shows us that the government will still continue to crowd market in year 2025, and also means that borrowing for most corporates will be elevated at least the first half of the year, and that may not be too great for them.
Right, and looking at the naira so far, the trades we've seen, it's a midweek trading session that's opened at this time. How are you seeing the naira trading for this week? We're still going to see that range we're used to.
I think if you notice from December 1st when the MFM platform was launched, we've seen a bit of calmness in the markets, and because what that platform brought to the table was it brought market depth, it brought price discovery, and also so it simply means that you can actually see at a glance what is happening in the market. It's more like it's not like the opaque market that we used to have, that you don't actually know the total volume of demand in the market. So that has actually kept the currency stable for over time. And there are times when there are a lot of interest in the market. You are seeing more bid than offer in the market. We tend to see the central bank also coming into the market in such a time like that to actually intervene in the market and sell FX into the market. But the good side part of this platform is the fact that it's an anonymous platform where you don't even know who is buying or who is selling. So when central bank comes to the market, you don't even know that central bank that is coming to the market to sell. Maybe at the end of the day, when you need to settle, you get to know your seller, and I think that also has actually helped the market. So I see this market more stable, the better part of this week. Even in Q1, we may likely be seeing more of what you mentioned as the range trading, where market move up and it comes down. So it simply means that when Naira is looking heavily on the price, we will tend to see the central bank come to the market to actually sell FX into the market. And we have seen that also impact the foreign reserve. At the beginning of the year, the foreign reserve opened around 40.87 billion. Currently, we are around 40.1 billion level. So it simply means that there has been a bit of outflow on the part of central bank to actually help to actually stabilize the market. Of course, that is what is expected of the central, because currency stability is also within the confine of their responsibility. And they mentioned clearly to the market that the currency is not fully floated. It is more like a managed floating system. And I think that is the way the central bank will continue to go around this, at least in the foreseeable time.
Right, and we know in 2024 we tapped the Eurobond market after a long time, after a hiatus, and now seeing the body language from the U.S. Fed, it was supposed to be about 4 cuts in 2025, but now it's been reduced to about 2, and they're anticipating how the Trump's policies will impact inflation, going into 2025. So did we tap the Eurobond market at the wrong time?
Well, I think we went in at a good time because, sincerely speaking, the time when we went to the market was just to borrow to actually fund the 2024 budget. And if you look at it very well, we went in towards the end of the year. At the beginning of the year, we still saw more like not so dovish Fed at the beginning of last year, and of course they promised that we will see rate cut at the later part of the year. And so what the government did was that they waited till about the time when we start seeing the posture of the Fed change to more of that extremely dovish stance, and that's one of the reasons why we went into the market at that particular point in time. And you can actually see the level of subscription, which also shows the fact that a lot of them are actually attracted to the instrument because we saw close to over $9 billion worth of subscription at that auction. So I think that we went in at the right time last year. So for this year, we just need to actually time the market appropriately as well. We need to actually follow what the US Fed is doing. We need to follow what will be the impact of Trump's administration's policy on the economy, both on the US economy and the global economy. And that's so as to be able to take advantage of that window that will be open and be able to raise funds at a lower rate. Just last week, the Benin Republic was in the market to raise a Euro bond, and they were able to raise a 16-year bond at around 8.625. And I think that's a very good one for that level of tenor. And I think also that the window is still very much open, but we can actually wait for a better time that we can capitalize on the market and raise at a lower level.
All right, definitely. All eyes on most of these markets. Most years, the previous year, 2024, we had most of the doom expectations for most of these economies, but we still saw risk assets do really well. I wonder what's going to play out in 2025, but we'll keep watching. Thank you so much. That's Mr. Oladipo Ajayi, Head FX Fixed Income, Chapel Hill, Denham. Thank you so much for coming on today.
Yeah. You're welcome. Thank you very much, Olaji, for having me on this morning.
All right, so the markets are open. We'll give you a broader perspective on what's playing out for the local bourse and most of the global markets that we track. That's at 1 p.m. on Business Incorporated. Stay tuned for that. That's it for me on Business Morning. I hand things over to the Sunrise Daily team.